There is a federal rule that most retirees have never heard of, not because it's secret, not because it's complicated, but because nobody takes the time to explain it clearly. And yet, every single year, thousands of honest people who worked their entire lives, who saved carefully, who did everything right, find themselves staring at a letter from their bank or a federal agency, not because they committed fraud, not because they hid money, but because a perfectly legal transaction triggered an automatic alert. And what makes it even more painful is that in the vast majority of cases, these people thought they were protecting themselves. They thought they were being careful, except what they had heard was wrong, or worse, it was half the truth. And half the truth, in this specific area, can cost you thousands of dollars, a frozen account, and months of stress you absolutely did not deserve. I want to tell you a true story. The story of a woman I will call Margaret. She was 69 years old, a retired school teacher. Her husband had passed away a few months earlier after a long illness. She found herself alone, exhausted, trying to reorganize her financial life. They had accounts at 2 different banks, 30 years of accumulated savings, and she just wanted to consolidate everything in one place. So she started making transfers. $9,000 here, $8,000 there, $6,000 a few days later. Not because she was trying to hide anything, but because she was grieving, overwhelmed, and the last thing she wanted was to deal with one large, complicated bank transaction on top of everything else. 6 weeks after her last transfer, she received a letter, a request to explain her transaction pattern. A 69-year-old widow who had simply wanted to consolidate her savings was receiving an official inquiry from a federal agency. I will come back to what she should have done. But first, let's understand exactly how this system works. Here is what happens behind the scenes every time a cash transaction exceeds $10,000 in the United States. The bank is legally required to file a report with a federal agency, automatically, without notifying you, without asking your permission. This report is called a Currency Transaction Report. It goes to FinCEN, the Financial Crimes Enforcement Network, which is a division of the US Treasury. I want to be very clear about this, because this is exactly where so many people get tripped up by fear. That report is not an accusation. It is not the beginning of an investigation. It is just an administrative record. Banks file millions of them every year. The overwhelming majority lead to absolutely nothing. That is not the problem. The problem is what people do when they hear about that $10,000 threshold. At some point, the information started spreading. Between family members, between neighbors, on the internet. People started thinking, if I go over $10,000, the bank files a report on me. So if I stay under it, I'm safe. And from that moment, certain behaviors took hold, depositing $9,800 instead of the full amount, making 2 deposits a few days apart, asking a spouse to deposit half at a different branch. These behaviors seem reasonable. They seem cautious. They seem like common sense. Except they constitute a federal offense. It is called structuring, and it is illegal. Not because the money is dirty, but because you deliberately broke up a transaction to avoid a regulatory report. It does not matter that the money came from a lifetime of honest work. The simple act of intentionally splitting a transaction to stay under that threshold is a federal crime. And that is exactly the cruel irony of this whole situation. The people who are trying to avoid trouble are precisely the ones creating it. I want to walk you through 3 very concrete situations. Situations that come up regularly for retirees. And for each one, I will show you exactly where the trap is and what to do instead. First situation. You have an old pickup truck sitting in your driveway for 10 years. You finally decide to sell it. The buyer hands you $11,000 in cash. You go to the bank and deposit the $11,000. Your bank files a report. Your name appears in a federal record. I know that sounds alarming, but it is completely normal. You did nothing wrong. The report exists, and it is harmless. What causes the problem is what comes next. You go home. You mention it to a friend. Your friend tells you you should have kept it under $10,000. Next time you have cash to deposit, you put in $8,000 this week and $3,000 the following week. Just to keep things simple, you tell yourself. That is where everything goes wrong. That split deposit is precisely what draws the attention of investigators. What you should have done is deposit the $11,000 all at once. The entire amount in one transaction. Yes, a report gets filed. It changes nothing about your life. What protects you is the paperwork. Keep the bill of sale. Keep the title transfer. Keep your deposit receipt. If anyone ever asks you anything, you have your answer right there on paper. Clean, clear, and impossible to dispute. Second situation. Your son wants to help you financially, or your daughter gives you $15,000 to help cover medical expenses. Legally, this is perfectly fine. A gift is not income. You do not owe taxes on it as the person receiving it. But here is what happens in almost every family when this comes up. Everyone tries to be helpful. Your son says, "Let me send it in a few smaller wire transfers so the bank does not make a big deal out of it." Your daughter says, "Just deposit a little at a time. It is more discreet." Your spouse says, "I will put half in my account and half in yours." I understand why it feels like the right move. Nobody wants hassle. But every single one of those suggestions is structuring, and it does not just expose you, it can expose your entire family. What you actually do is deposit the full amount in one single transaction. If it is a wire transfer or a check, there is already a clean paper trail and you are essentially done. If it is cash, you go to the bank, you tell them it is a family gift, and you deposit everything at once. The key element here is a gift letter. Do not overthink it. You do not need a lawyer. It is simply a piece of paper, signed and dated, that says something like, "I gave this person this amount of money as a personal gift on this date." That letter, combined with your deposit receipt, covers you completely. Third situation. Margaret's situation. The account consolidation. No sale. No gift. Just your own money, moving from one bank to another. The reason does not matter. What matters is how you do it. If you transfer your own money in several smaller transactions spread over a few weeks, the bank's automated monitoring system will see exactly the same pattern as a potential structuring case. Repeated transactions, all landing below $10,000 at regular intervals. The algorithm does not know you just lost your husband. It does not know you are 69 years old and that you have been saving honestly for 40 years. It sees a pattern and it flags. What you need to do is move the money all at once, not in pieces. Use a wire transfer or a cashier's check. When the teller asks where the funds are coming from, and they might, your answer is simple. These are my personal savings being transferred from my account at another bank. One sentence. Do not elaborate. Keep on file a bank statement from the source account showing the balance before the transfer, your wire confirmation, or the cashier's check stub. And if the money came from a certificate of deposit that matured, keep that maturity notice. 5 minutes to pull these documents together, and they protect you indefinitely. Let's talk about what actually keeps you safe. Not in an abstract way, but concretely, piece by piece. The first element is a document that explains where the money came from and why it moved. A bill of sale if you sold something. A gift letter if someone gave it to you. A bank statement if you moved your own money between accounts. Without this, you are a person who deposited a large amount of cash and has a verbal explanation. With it, you have a paper answer that immediately closes the conversation. The second element is a bank statement from the source of the funds. The first question anyone will ever ask you, if they ask you anything at all, is this one. Where did this money come from before it arrived here? If your answer is a document, you are in a completely different position than if your answer is a story. Stories get interpreted. Documents do not change. The third element is your transfer confirmation. Wire receipt, cashier's check stub, whatever form the transaction took. 30 seconds to save it. Keep it for at least 3 years. The fourth element is consistency between your tax return and your bank records. If you sold something and deposited the money, that sale may need to appear on your return. When both records tell the same story, there is nothing to investigate. And the fifth element is your behavior if anyone ever asks you a question. Answer once, with your documents in front of you. Do not over-explain. Do not call back with additional details. Do not get nervous and start adding information that was not requested. 1. Clear answer, backed by paperwork. If it ever goes further than a routine bank question, stop talking. Call a CPA or a tax attorney before you say anything else to anyone. There are 3 misconceptions I hear regularly, and I want to address each one directly, because any one of them could cause you real problems. First misconception: if I stay just under $10,000, I am safe. You are not. You are actually in a more exposed position. $9,900 is one of the most flagged deposit amounts there is. Banks are not only watching for the $10,000 threshold, they are watching for the pattern of someone trying to stay below it. Repeated deposits that all happen to land just under $10,000 look exactly like what someone who knows about the rule and is trying to dodge it would do. If your amount is $11,000, deposit $11,000. Second misconception: this only happens to people who did something shady. It does not. The system is automated. It does not look at your history or your character before flagging something. It sees a pattern and it fires off a report. Plenty of completely honest retirees with perfectly clean money have received letters because a transaction looked off on paper. That is the entire reason I am talking about this today. Third misconception, and perhaps the most dangerous one for retirees specifically: I am retired. I am on a fixed income. The IRS is not interested in me. There is no age exemption. There is no retirement exemption. The same report gets filed on a 72-year-old depositing cash as on a 35-year-old business owner. Your age does not protect you. Your paperwork does. Margaret was eventually able to explain her situation. She had kept her statements from both accounts. She was able to show that the money had been hers for decades. The matter was resolved without consequences. But she told me something that stayed with me. She said that during the 6 weeks between receiving the letter and the resolution of the case, she had not slept normally a single night. She woke up every morning thinking about that letter. She felt like she had done something shameful when all she had done was move her own savings. That stress, those sleepless nights, that shame she had not earned, all of it could have been avoided with one different decision: transferring the money all at once. This rule was designed to fight money laundering and serious financial crime. It was never meant to be a trap for retirees who sold an old truck, received a gift from their children, or consolidated their savings after losing a spouse. But the trap closes anyway, not because these people are criminals, but because they received bad advice, or no advice at all. You are now among the people who understand how this mechanism works. Deposit your money in full. Keep your paperwork. And if someone ever asks you a question, you will have your answer ready. That is genuinely all there is to it.